Welcome to our investment outlook for 2017. I'm Adi Manapa, Head of Asset Allocation and Portfolio Solutions. With me today is Steve Bryce, our Chief Investment Strategist. Welcome, Steve.
Hi, Adi. Our theme this year is that 2017 is the year of the pivot. From an economic and political perspective, there are four key areas we're focusing on. The pivot from a reliance on monetary policy to the increased role of fiscal policy. Second, the shift to rising inflation. Third, the pivot to a more protectionist environment. And finally, the emergence of multipolarity, which is likely to erode the US's dominant position within the geopolitical environment. While some of these trends were already developing, we believe that the US election outcome may have actually accelerated them. The key question is to what degree these themes gather momentum. For instance, we believe that US fiscal changes will only take place in the second half of this year, and therefore will have a limited impact this year and a greater impact in 2018.
Given the uncertainties, I think a scenario-based approach to investing is required. This will prevent focusing on one or two asset classes, which is important in the current environment, and will prevent further risks from developing within an investor portfolio. For the past 3 years, we've recommended a multi-asset income approach, and this has been for both income-focused and total return-focused investors alike. This has worked well, especially in a muddled-through scenario, which was our central scenario at that point. But going into 2017, we actually think total return investors should focus on the reflationary scenario, and this means adding an element of growth into their allocations. For an income investor, the multi-asset income strategy still remains valid. We think the strategy can generate a 4 to 5% yield in the current environment.
Adi, going back to a point you made earlier, I believe investors need to be truly diversified. We're late in the US economic cycle, and our central scenario is that inflationary pressures build, with the key uncertainty being how quickly. Our central scenario is that rise will be modest, but there are upside risks to this. Equities would do well if it is a modest rise, but a sharp rise would likely be damaging to both bonds and equities. Therefore, an investment allocation should include exposure to areas that help hedge against such a scenario. Our favoured area is multi-asset macro strategies that can take positions that can benefit from a rise or fall in the value of equities, bonds, currencies and commodities. This asset class can therefore be seen as one that offers insurance-like characteristics. We believe the long-term trend for lower US dollar bond yields has probably reversed. That said, we expect this rise from here to be relatively gradual. Overall, this means we prefer taking exposure to corporate bonds rather than long-dated government bonds. Our two preferred areas are US leverage loans, which pay a yield that rises in line with short-term interest rates, and US dollar high-yield bonds.
Perhaps of interest to investors is the Asian dollar credit space. We remain comfortable with this asset class, but actually prefer the investment grade area over high yield. Credit quality in the investment grade space has actually improved marginally, but in high yield, it's on a deteriorating trend. The earnings outlook has improved materially, particularly in developed markets, and the shift towards fiscal policy may extend the economic cycle. Within equities, we prefer the US, given broadening of earnings growth. Energy companies should benefit from rising oil prices. Banks should be supported by gradually rising interest rates and potential deregulation. And increased spending on infrastructure should support many industrials. And this is before you factor in the direct benefits from tax cuts that President Trump might choose to implement. From a thematic perspective, we like the tech sector in the US, as well as the small cap space. Our second preferred market is Japan, where we see a benefit from a weakening yen, but also reduced deflationary pressures.
I suppose another key question is, are we still bullish on emerging market equities? On balance, the answer is yes, but in the short term, dollar strength may be a bit of a headwind. Within Asia, our preferred markets are the reform-orientated India and Indonesian markets, which are potentially less exposed to any US protectionist measures. Within China, we have a preference for new economy sectors.
Right.
The US dollar is likely to be supported in early 2017 as the market refocuses on policy divergence between the Fed on the one hand and the European Central Bank and Bank of Japan on the other. However, we expect US dollar gains to be relatively limited in magnitude, as we believe reducing concerns about deflation may reduce the pressure on central banks to ease monetary policies elsewhere, including in Europe. This means any dollar strength may be short-lived. Against this backdrop, and that of a weakening Chinese renminbi, we expect Asian currencies to start the year on the defensive.
Well, from a commodity perspective, we believe oil prices will continue to move higher as demand starts to outstrip supply. For us, the deal between oil producers to cut production is not that important, but it certainly reinforces our outlook. We've become less optimistic on the outlook for gold prices. The key question here is how quickly the Fed hikes interest rates in a response to rising inflationary pressures. Overall, we believe a small 3 to 5% allocation makes sense to gold and gold producers.
Thank you for joining us. See you again soon.
Thank you.